I told you so. That Bank of Canada would increase interest rates. There would be a higher probability of them increasing interest rates in the June meeting than cutting rates at all. Don't believe me? Check out this video that I posted 3 weeks ago talking about Bank of Canada hiking rates versus cutting rates. Now, my take is, I think we could see in the next meeting in June a possibility of Bank of Canada raising rates another time, just like Australia. I think there's a higher chance of that happening rather than a cut. Now, I'm not the interest rate whisperer, okay? I can definitely be wrong. If I'm wrong, I'm happy to come out online and say, hey, I was wrong about this situation, right? But the reason why 3 weeks prior I was talking about a higher chance of an interest rate hike rather than the cut was because I look at macro information. I'm looking at the data. I'm looking at Canadian CPI, jobs data, inflation, and not just Canada, the world, right? Australia, for example, that did a surprise rate hike. They paused and then raised rates. And I said that in the video. I wouldn't be surprised if Bank of Canada does the same thing. I think there's a high probability that they would do that. And guess what? They did it. They did it today. They hiked rates by 25 basis points. So what does this mean? Does that mean that, hey, we're going to get more rate hikes and we're going to hike more and Bank of Canada is going to continue on this rate hike cycle and continue to be aggressive? Or is this a one and done scenario here? Or are we going to get the rate cut still that everyone was talking about a couple months back? I mean, that has completely been priced out. Anything is possible in this scenario, right? Unless we're getting something in the economy, something that Bank of Canada is worried about, the shit is hitting the fan, right? Then yes, you're gonna get the rate cuts. If that's not the case, if there's still excess demand, if there's still people going out and spending money and traveling and putting bids and offers on certain properties and pushing property values higher, and if it's still, the labor market is still strong and the economy is still strong, there's no reason to be easing. That means the economy can handle whatever rate hikes are happening and the tightening that's happening, right? You would think that, even though I totally understand. You go to the grocery store and then, hey, look, the prices are higher and you're feeling the pinch in your wallet. I totally agree with you. But in terms of the Bank of Canada, in terms of the central bank, how they're looking at things, the lens that they have, right? They've got a mission. Their mission is to bring inflation down, bring it down to that 2% target. And that means that they will continue to create conditions tight and tight and tight. And even if they don't hike rates further, they will keep things tight. They will continue with QT. They'll continue to deplete the money out of the system, create tightening in the credit conditions so that, yes, that excess demand can come down. That demand can come down so we can see inflation come down, so that people stop spending, so that the economy starts to really, really slow down, aka recession, so that they can reach to their 2% target. Now, if you don't believe me, let's dissect the Bank of Canada's full statement. They came out with the statement. Let's read it here together. We'll go over it together. So it says here, the Bank of Canada today increased its target for the overnight rate to 4.75%, with the bank rate at 5% and the deposit rate at 4.75%. The bank is also continuing its policy of quantitative tightening. So in other words, what that line basically means, they hiked by 25 basis points and they're continuing with QT. They're not easing, they're not printing money, they're taking money out of the system. They are contracting the system, they're creating tighter credit conditions. So you stop going out, spending. Maybe it's harder for you to get a loan so you can spend in the economy because they want you to stop so they can attain the goal of reaching to their inflation target. Now let's get into this second paragraph here. It says, globally, consumer price inflation is coming down, largely reflecting lower energy prices compared to a year ago. So yes, yes, we are seeing inflation come down from its peak. I totally agree with you. You can even say we're in a disinflation or deflation period where you are seeing many of the commodity prices come down lower because of the weak demand. You like take, for example, oil, crude oil, or lumber prices. They are starting to come down globally. Now, in this paragraph, it says, but underlying inflation remains stubbornly high. Even though you're seeing the headline numbers, you're seeing certain energy prices come down, but the underlying inflation numbers, they're stubbornly high. Let's take one example, shelter. Shelter prices are stubbornly high. They're sticky. The rent, the housing prices are still up there. It's still sticky. It's still stubbornly high. There's certain areas where we still need to see inflation come down. So the battle is not done. That's their job. Now it says here, while economic growth around the world is softening in the face of higher interest rates, major central banks are signaling that interest rates may have to rise further to restore price stability. The Bank of Canada is telling you something. That, hey, we are reading what globally is happening around the world. We are synchronized with the world. Also another reason why they went with the rate hike, because they're seeing around the world that, yeah, central banks are hiking because they need to fight this inflation. You're seeing the global central banks around the world being synced, understanding, reading each other, saying that, hey, they're hiking there, Australia is hiking there, the US is hiking there, hey, maybe we should do something also, so we all combat inflation and fight it and bring it down. Now it goes on in this article here that again, major central banks are signaling that interest rates may have to rise further. Like I said, in the United States, it says here, in the United States, the economy is slowing. Although consumer spending remains surprisingly resilient, the labor market is still tight. Right? So it's pointing towards the US. It is looking at the US. It was wrong many times before also. And the US was wrong as well. The US Central Bank was definitely wrong. They came out and they were saying, 2 years back that inflation was going to be transitory. And guess what? Bank of Canada was saying the same thing too. Now the US admitted that, hey, we were wrong. We got to do something about it. And what did the Bank of Canada do? They did the exact same thing. They followed the US, right? So they're saying here, look, the US, the economy is slowing. Although the economy is slowing, consumer spending surprisingly is still high up. Why? Why is that? Could it be the crazy amount of money printing that they did in 2020, 2021? The crazy stimulus money that came out? Maybe it could be that. So that's keeping spending higher. And also labor. The labor market is still strong. It's resilient as well. The jobs number in the US just last Friday came out stronger than expected, keeping the spending going on higher and higher and keeping that inflation higher up there as well. So this resilience is not good. When I tell you that the resilience and the strong labor market, it basically gives them more reason, the central banks more reason to combat inflation, right? Because you're basically making an argument here, right? Even though you may not agree with it, you're basically making an argument here that, hey, if the labor market's still strong and spending is still strong, yes, the economy has slowed and blah, 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 but people are still working, they still got their jobs, and inflation is still high. That means they're handling whatever we're doing, the tightening that we're doing, the rate hikes we're doing. So, okay, no problem. Let's do another rate hike and see how everyone feels after that, right? So again, moving on, it says economic growth has essentially stalled in Europe. So they're talking about Europe here, but upward pressure on core prices is persisting. So yes, the headline number that takes in consideration to energy prices, that has been under pressure. But when you look at the core prices, when you take out the volatile numbers from energy, yes, you're seeing the core components still high up there, it's still sticky, and they need that to come down, right? That's still persisting. Now, they also say growth in China is expected to slow after surging in the first quarter. When you look at Chinese data, Caixin PMI, and the other data points that they had, you are seeing weakness there. The growth is slowing down there. Everyone said that China coming back online is going to spur up the growth and the demand in the economy. And what did we get? We got none of that. So we're seeing, yes, a slowdown there in China. So it's not just Canada, everyone around the world is feeling this growth slowdown, but still a lot is needed to be done with the inflation. Now, it says here in the last line here, the financial conditions have tightened back to those seen before the bank failures in the United States and Switzerland, right? So they're talking about the conditions, the tightening conditions you're seeing. We haven't seen those since around 2007, 2008, when all these bank failures were happening back then. And if you look at the Canadian bonds, the yields there, especially the 5-year, they're at levels, at 2007 levels. So they're at quite high elevated levels, basically telling you that conditions are really tight in a sense that it goes all the way back to the 2007 levels. Right? Now it goes on talking about here in the statement that Canada's economy was stronger than expected in the first quarter. It says that the labor market remains tight, higher immigration, participation rates are expanding the supply of workers, but new workers have been quickly hired, reflecting continued strong demand of labor. Overall, excess demand in the economy looks to be more persistent than anticipated. So Bank of Canada is telling you right here that look at this, right? It's not up to Bank of Canada to decide how many immigrants to come in, right? Bank of Canada looks at the monetary policy side of things. They control the money supply, the interest rates, right? So if the government, if Trudeau wants to bring more inflow of people and those people are getting hired and there's an excess of demand and prices are still not coming down and spending is happening, what is the job of Bank of Canada? Is it to say, hey, bring in more immigrants? No. Their job, their mandate is to control the labor market, to control inflation, make sure that their currency is stable and doing well. And one of their jobs that they're trying to accomplish, which is bringing inflation down to their 2% target, they are failing at. So since the labor market is tight and fine, when they're failing at the inflation part, that means that, hey, there is excess demand, there's still work to be done, thus the rate hike, and thus maybe, who knows, more rate hikes, more tightening as they're doing right now. Now, going into the statement a little bit more further, it says here that based on accumulation of evidence, Government Council decided to increase the policy interest rate, reflecting our view that monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation sustainably to the 2% target. Quantitative tightening is complementing the restrictive stance of monetary policy and normalizing the bank's balance sheet. Governing Council will continue to assess dynamics of core inflation and outlook for CPI inflation. In particular, we will be evaluating whether the evolution of excess demand, so again, focusing on excess demand, how is this excess demand playing out? Inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target. So again, watching the excess demand, watching the inflation expectations, watching the wage growth, watching the corporate pricing. Is everyone playing around with the corporate pricing, pushing prices higher, right? If that's the case and that continues to persist, then guess what? They're going to do something about it, right? They're going to do something about it. They are two different entities. The government and the central bank are two different entities. They are not in the same boat as the government. They have to fight inflation because that's their mandate, that's their job, that's their target. Now it says here at the end, the bank remains resolute in its commitment to restoring price stability for Canadians, right? So again, saying that we got to do something with this inflation, and we're going to do whatever is needed. And if that means higher rates, more QT, more tightening, they will do so. Now, it's really interesting here. I'll mention one thing. They took a wording out the statement, right? They said that they had a statement before that said Bank of Canada remains prepared to raise the policy rate further if needed to return inflation to the 2% target. Now, that's why you're seeing on like today where the Canadian dollar is coming down, because they removed that sentence there. And some are taking this as that, okay, that means it's a one and done. That means that, hey, Bank of Canada is saying that because they took out this statement saying that, they need to raise further to the 2% target, that's considered kind of dovish. So that could mean that that's a one and done and they're not going to do much. However, they replaced that with a new paragraph saying, again, Governing Council will continue to assess the dynamics of core inflation and the outlook for CPI inflation, just like I went over in the last paragraph. In particular, we will be evaluating whether the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target, right? So that last paragraph was put in, replacing the previous statement saying remains prepared to raise the policy rate further if needed to the inflation target, 2% target. So people are taking that as if, okay, that's dovish. Why did they take it out? Does that mean it's a one and done? My views, you can take it as in that they're more cautious. And why would they be more cautious? Right? Think about it here for a second. Why would they be more cautious? They went with the rate hike. Can they not raise rates further down the road? They can definitely do so. They can definitely do so if if that excess demand is still there. But they put that there, from my thinking, is because if they're expecting a recession, if they're expecting some sort of credit crunch, really things to worse off after this summer in September, November, then there is a reason to be in pause mode. There's a reason to be not hiking rates as aggressively and just hold off and wait and see what happens. Now, on top of that, after today's meeting, if you look at what's being priced in when it comes to interest rate probabilities, the markets are pricing in a 35% chance of a 50 basis point rate hike by September of this year. And if not, then a 50 basis point rate hike, 2 rate hikes by the end of this year. And that is sitting at a 55% chance. Of course, this can change. These probabilities change every time there's new data. What I would say here is, going forward, again, watch the macro. Watch what's happening globally. Watch what's happening, most importantly, with the data. Watch what's happening with the Canadian inflation data, the jobs number. There's a jobs number coming out for Canada on Friday this week. I'm not sure when I'm going to upload this video, but it's coming out this week. It's important to watch that and continue to monitor the communication from Bank of Canada, the data month-to-month basis, and most importantly, just like I read in this statement, they keep talking about other countries out there, right? They're talking about Europe, they're talking about the United States, right? So all of this, the US, they're definitely following. They're seeing this is all globally synchronized. All the central banks are globally synchronized, and they're hiking rates and watching how one economy is doing, how the other economy is doing, and then making their decision. Just like how I started off in this video talking about how Australia, hiked rates, and that was my reason of why I would see Bank of Canada doing the same thing. It's important to monitor that of other countries who are in pause mode or decide to go back into pause. It'll be interesting to see how Bank of Canada plays out their interest rate policies and their tightening policies in the future. So that's about it. That's all I have to say. Hope you learned something from this. Leave a comment below, subscribe, hit the like button and the bell icon to be notified on the next video. And if you like content like this, you like to hear about macro news, macro information, and how it relates to the markets, whether it's Canada, US, Europe, etc., etc. And if it relates to stocks, bonds, commodities, currencies, and even crypto, feel free to subscribe. And I'll see you guys in the next video. Cheers. Bye.